Good, I can confirm the March 19th, 2026 vote is real, and the comment period deadline is June 18th, 2026, which is about 90 days. Now let me rewrite the script. Something just shifted in the banking system, and hardly anyone is discussing it. Not headlines, not breaking news, not even a scrolling banner at the bottom of your screen. But behind closed doors, the regulations that are meant to safeguard your money were quietly revised. And here's the part that should make you pause. You now have a 90-day window connected to that decision, and most people don't even realize it exists. This isn't about some abstract policy discussion or something buried deep in financial terminology that only impacts Wall Street. This affects your checking account, your savings, your retirement, anything linked to a bank. Because at the precise moment when the financial system is displaying signs of strain again, the people in charge didn't strengthen the rules, they relaxed them. And they did it without consulting you, without clarifying it, and without placing it where you'd actually notice it. The real question isn't just what shifted, it's why it shifted right now and what that reveals about the system beneath everything you depend on. Because when you start pulling on that thread, you don't just discover one issue. You discover layers, 4 of them, stacked directly on top of your money, each one altering how secure that money actually is. And once you observe all 4 together, it becomes very difficult to view your bank account the same way again. Hi, I'm Elena. And what I'm going to do in this video is guide you through exactly what shifted using the actual documents, the votes, and the figures without the noise, without the alarm, and without assuming you have a background in finance. Because the reality is most of this isn't complicated. It's just not presented in plain language. And that gap between what's occurring and what people comprehend is where confusion and risk tends to reside. So we're going to bridge that gap. Step by step, I'll demonstrate how the system was already organized before this decision, what the new rule adjustment actually does, and why it matters right now. Not in theory, but in practical terms that connect directly to your everyday financial life. And by the time we're finished, you'll be able to grasp the full picture clearly enough to make your own decisions about what to do next. But to appreciate why this recent change matters as much as it does, we have to begin with something most people never consider. What's actually occurring with your money the moment you deposit it in a bank. The moment you deposit money into a bank, something significant and often misunderstood occurs. It feels like you're placing your cash somewhere secure, like it's resting there waiting for you whenever you need it. But in reality, that's not how the system operates anymore. And in some ways, it hasn't operated that way for a long time. Back in March of 2020, the Federal Reserve made a decision that fundamentally altered the structure of banking in the United States. They reduced the reserve requirement to 0, not lowered it, eliminated it. What that means in plain terms is that your bank is no longer legally obligated to keep a single dollar of your deposit on hand. Not a percentage, not a fraction, 0. So when your paycheck reaches your account, it doesn't just rest there. It becomes part of a much larger pool of capital that the bank can move, lend, invest, or deploy elsewhere. And under the current rules, there's no minimum amount they have to maintain in reserve in case you or everyone else wants their money back at the same time. A simple way to visualize this is to imagine a parking garage where you leave your car overnight. You expect it'll be there in the morning exactly where you left it. But in this version of the garage, there's no rule requiring them to keep your car in your spot or even in the building. Instead, they're permitted to rent it out while you're asleep, send it across town, maybe even across state lines. And when you return for it, the only way you get your car is if enough other cars happen to be returned at the same time. Most days, that system functions fine. People come and go, cars cycle in and out, and no one notices. But the entire structure depends on one thing, not everyone appearing at once. That's the foundation your bank account is built on today. And what makes this more noteworthy is that this wasn't a temporary emergency measure that got reversed. It's still in place quietly, permanently, at least for now. So that's layer 1. Your money feels like it's there, but structurally, it isn't resting still in the way most people imagine. Now, layer 2 builds directly on top of that. And this is where the rules shift from how banks function to what happens if something goes wrong. Because after the financial crisis in 2008, there was a massive backlash against taxpayer-funded bailouts. Hundreds of billions of dollars were used to stabilize major banks, and the public response was loud and clear: never again. So lawmakers stepped in and rewrote the playbook. On the surface, it sounded like a victory. No more bailouts using taxpayer money. But what replaced it is something most people have never had clearly described to them. It's called a bail-in. And the difference isn't just technical, it's personal. In a bail-in scenario, if a major bank runs into difficulty, it doesn't reach outward to taxpayers for support. It reaches inward into its own structure. That includes bondholders, shareholders, and critically depositors, which means people with money in the bank. Because legally, when you deposit cash, you're not storing it in a vault with your name on it. You're lending it to the bank. In return, they give you a claim, a balance on a screen, but not ownership of specific physical dollars. In legal terms, you become what's called an unsecured creditor. And that phrase matters because it defines your position if things start to unravel. You're part of the system that can be used to stabilize the bank itself. Now, this is usually where people say, okay, but that's why we have FDIC insurance. And that's a fair point because up to a certain limit, that protection has functioned historically. It's been reliable, consistent, and for decades, it's done exactly what it was designed to do. But once you start examining closely how that system is organized today, especially in the context of everything else we're walking through, you start to see why that reassurance might not be as absolute as it sounds on the surface. And that's where the next layer begins. Because the real question isn't whether protection exists, it's whether it's constructed to handle the kind of pressure the system is experiencing now. So let's look directly at that protection, because this is where the conversation transitions from how the system works to whether the math behind it actually holds up. The FDIC, the Federal Deposit Insurance Corporation, is the backstop most people rely on without thinking twice. It's the reason you'll hear your money is insured up to $250,000. And historically, that statement has been true in practice. Since its creation in 1933, the FDIC has stepped in and covered insured depositors every single time it's been tested. That track record matters. But what also matters, especially right now, is the scale of what it's promising compared to what it actually has available. As of now, the FDIC holds roughly $129 billion in its insurance fund. That sounds like an enormous number, and on its own, it is. But the total amount of deposits it insures is over $10 trillion. When you break that down, it comes out to about $1.17 set aside for every $100 it guarantees. And that's not a rounding error. That's the architecture. The system isn't designed to cover everything at once. It's designed around the assumption that it won't have to, that failures will be isolated, manageable, and spread out over time. And most of the time, that assumption holds. But when stress starts to accumulate across multiple institutions at once, that's when the gap between perception and reality becomes harder to dismiss. We got a glimpse of that in 2023 when several major regional banks failed in rapid succession. In order to cover insured depositors, the FDIC had to step beyond its existing reserves and borrow approximately $93 billion. Think about what that implies for a moment. The system that insures your deposits had to borrow money to fulfill the insurance it had already promised. Again, that doesn't mean failure is inevitable, but it does reveal how tightly balanced the system really is. It works until it's forced to stretch. And when it stretches, it depends on external support, coordination, and timing. So now, if you step back and review the first two layers together, your money not being required to sit in reserve and the insurance system operating on fractional backing, you start to see a pattern. It's not about one weak point. It's about how those points interact under pressure. And that brings us to the third layer. Because even within that system, if something does go wrong, there's another detail that most people never see coming. It's not just whether your money is protected. It's where you stand in line to get it back. Because in a bank resolution scenario, there's a hierarchy, a legal order, that determines who gets paid first, who gets paid later, and who may end up absorbing losses. And here's where things become less intuitive. The financial contracts that banks use to manage risk, things like derivatives, are given special priority under current regulations. In simple terms, that means those obligations can be settled before depositors are fully made whole. Now, derivatives might sound abstract, but the scale is anything but. We're talking about tens of trillions of dollars tied up in these instruments across major financial institutions. Individual banks can hold exposures in the tens of trillions alone. And across the system, the total climbs even higher. So when you imagine a line forming during a crisis, people expecting to access their savings, you're not standing at the front of that line. You're standing behind a massive layer of financial obligations that were never part of your day-to-day banking experience, but are deeply embedded in the system your bank operates within. And if that still feels theoretical, there's a real-world example that illustrates how this can play out. In 2013, Cyprus went through a banking crisis that forced exactly this kind of restructuring. Depositors woke up to discover that a significant portion of their funds, especially amounts above insured limits, had been converted into shares of struggling banks. Access to accounts was restricted. ATMs were emptied within days. Banks remained closed for weeks, and capital controls stayed in place for years. And more than a decade later, some depositors are still attempting to recover what they lost. That wasn't a fringe system or an isolated experiment. That was a modern banking environment with central oversight and deposit insurance frameworks in place. So when you combine everything we've discussed so far, the structure of deposits, the limits of insurance, and the priority order in a crisis, you start to see that the system isn't built on a single guarantee. It's built on a series of assumptions about timing, behavior, and stability. And as long as those assumptions hold, everything appears solid. But when they're tested, that's when the underlying mechanics start to matter in ways most people never anticipated. Now, if all of this still feels like something that exists mostly on paper, technical, distant, unlikely to actually surface in a real-world scenario, then what comes next is where that perception starts to shift. Because some of the clearest insights into how the system actually views these risks didn't come from critics or outsiders. They came from inside the room. In November of 2022, the FDIC held a closed-door meeting that was later made publicly available on their own website. It brought together high-level officials, people with deep connections to major banks, former executives from institutions like Goldman Sachs, and senior policymakers who've spent decades inside the financial system. And during that discussion, something was said that rarely gets communicated this directly. One participant acknowledged on record that depositors could be exposed in a crisis, that bail-ins are not just theoretical, but part of the framework. But in the same breath, the concern wasn't about whether the system permitted that. It was about how much the public should comprehend. Because if people fully grasped how these mechanisms function, it could trigger the very thing the system is designed to prevent, a loss of confidence. And that's the word everything hinges on, confidence. Because modern banking systems don't just run on capital, they run on trust, the assumption that your money will be there when you need it, the belief that the structure underneath is stable enough not to question. And once that belief starts to crack, behavior shifts. People move funds, they ask different questions, they stop assuming, and that shift alone can create pressure. Another voice in that same discussion framed it even more clearly, pointing out that there's effectively two audiences. There's the institutional side, large players who understand how the system operates in detail. And then there's everyone else. And the implication was that those who really want to comprehend will find a way to comprehend. But it's not something broadly highlighted. When you translate that out of policy language, it reveals something significant. The system depends on most people not digging too deeply into its inner workings, not because there's a single hidden flaw, but because the full picture is complex, and complexity can alter behavior if it's suddenly brought into focus. And that brings us directly into what just occurred. Because against that backdrop, where confidence is already a critical variable, the people overseeing the system made a decision that moves in a very specific direction. On March 19, 2026, three key regulatory bodies, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency, voted on a set of changes tied to what's broadly known as Basel III. The name itself isn't important. What matters is what these rules were originally designed to do. After the 2008 financial crisis, regulators recognized that banks needed stronger buffers, more capital held in reserve to absorb losses if markets turned. So they implemented stricter requirements, especially for the largest institutions, to make sure there was a cushion between instability and depositor impact. That was the arrangement for more than a decade. More resilience, more protection, more margin for error. But in this latest vote, that direction shifted. The updated rules permit large banks to function with comparatively less of that protective cushion. In other words, the very buffer that was meant to absorb shocks before they reach the public has been decreased. And this didn't occur during a period of total calm. It's occurring at a time when multiple financial indicators are already showing strain, when interest rates are elevated, when global markets are adjusting, when liquidity conditions are tighter than they've been in years. Now, to be clear, this isn't being presented by regulators as removing safety altogether. The argument is that the system has evolved, that banks are better positioned, that flexibility is needed. But when you place that decision alongside everything we've already walked through, The zero reserve requirement, the structure of deposit insurance, the priority hierarchy in a resolution, it becomes part of a broader pattern. Not a single change in isolation, but a series of adjustments that all move in the same direction. Less immediate protection at the point where stress would be experienced first. And here's where that 90-day window we reference at the very beginning comes back into focus, because this decision isn't fully locked in yet. There's a formal comment period open right now, where the public can respond before the rules are finalized. Most people will never notice it. Most won't know where to look. But it exists, and once that window closes, the framework we've just outlined doesn't just remain theoretical. It becomes the defined structure going forward. That 90-day window isn't just a technical step in the process. It's one of the few moments where something like this is briefly visible before it becomes permanent. Right now, there's a public comment period open on the Federal Register. Anyone can submit a response. Not just institutions, not just lobbyists, anyone. And by law, those comments have to be reviewed as part of the rulemaking process. Now, whether they alter the outcome is a different question entirely, but the existence of that window tells you something important. This isn't fully set in stone yet. It's in that narrow phase where awareness actually matters, because once that window closes, the shift we've been discussing, the reduced cushion, the recalibrated safeguards, moves from proposal to policy. And at that point, it becomes part of the baseline assumptions the system operates on. Quietly, permanently, no announcement, no headline moment where someone explains it in plain English. It just becomes the new normal. And historically, that's how many of the most consequential financial changes happen. Not with a single dramatic reveal, but through gradual adjustments that only become obvious when you look back. So the question becomes, if this is happening now in this environment, what are the people closest to the system doing with that same information? Because one of the most consistent signals in financial history isn't what's said publicly. It's how capital moves privately. And when you start looking in that direction, a pattern begins to emerge that's difficult to ignore. Over the past year, one of the most closely watched investors in the world has been making a series of moves that stand out. Not because they forecast the future with certainty, but because of their scale and timing. Over multiple quarters, hundreds of millions of shares in major banking institutions were sold off. Not all at once, not in a panic, but steadily, consistently, in size. At the same time, that capital wasn't immediately redeployed into other risk-heavy sectors. It was held, parked, accumulated into a massive cash position. Hundreds of billions of dollars sitting on the sidelines. Now, that doesn't automatically mean something is about to collapse. Markets are complex, and there are always multiple reasons behind large portfolio decisions. But context matters, because alongside those moves, internal voices within the banking world have also started drawing comparisons that haven't been heard in a long time, specifically parallels to the period leading up to the 2007-2008 financial crisis. Not identical conditions, but similar patterns in how different indicators are aligning at the same time. Things like sustained high energy prices, a strong dollar index, pressure on equity markets, and rising long-term bond yields. On their own, each of these can be managed. But when multiple indicators begin moving together, they can create feedback loops, tightening financial conditions in ways that ripple across the system. And according to some of the analysts closest to the banking sector, several of those signals have already been triggered, while others are getting close. So when you step back and observe the full picture, you start to see two parallel tracks. On one side, regulatory adjustments that reduce certain buffers. On the other, large-scale capital movements that suggest a more cautious positioning from those paying closest attention. And right in the middle of those two tracks is where most people are standing, still operating under assumptions that haven't fully caught up to what's changing underneath. When you line everything up, not individually, but all at once, the picture becomes a lot clearer. You have a system where banks are no longer obligated to hold reserves against your deposits. On top of that, the insurance designed to protect those deposits operates on a fraction of the total it guarantees. Then in a worst-case scenario, there's a legal structure that determines who gets paid first, and depositors aren't necessarily at the front of that line. And now, layered over all of it, the very safeguards that were strengthened after the last major crisis are being adjusted in a way that decreases the buffer between instability and impact. None of these pieces on their own automatically lead to a crisis. That's important to state clearly. But systems aren't tested one piece at a time. They're tested all at once under pressure in real-world conditions that don't follow a script. And at the same time, you're seeing signals, subtle but consistent, from within the financial world itself. Capital shifting, risk being recalibrated, language from insiders that echoes earlier periods of stress. Again, not predictions, not guarantees, but indicators. And when multiple indicators begin to point in the same direction, the smartest approach isn't to panic, it's to pay attention. Because the real risk for most people isn't that they'll see something coming and overreact. It's that they won't notice it at all until they're forced to react. So instead of treating all of this as something distant or abstract, the more practical question becomes, what can you actually do with this information? Not in a dramatic all-or-nothing way, but in simple, grounded steps that bring your understanding in line with how the system actually functions today. The first step is clarity, knowing exactly how much of your money is covered under FDIC insurance and how much isn't. And that's not something you have to guess at. There's a tool for it. The FDIC's own electronic deposit insurance estimator lets you map out every account you have across institutions and see where you stand. Because one of the most common assumptions is that coverage applies per account. But in reality, it's structured per depositor, per bank, within specific ownership categories. And that difference matters more than most people realize. The second step is distribution. If you discover that you're holding amounts above insured limits at a single institution, one of the simplest ways to reduce exposure is to spread those funds across multiple banks or account types. It's not complicated. It doesn't require predicting anything about the future, and it aligns your positioning with the rules that already exist. The third step is perspective, reconsidering the assumption that a traditional bank account is the only or inherently safest place to store all of your liquidity. There are other instruments, other structures, each with their own trade-offs. But the key is understanding that safe isn't a fixed label. It depends on how the system around it is organized at any given time. And none of this is about trying to outsmart the system or anticipate a specific event. It's about removing blind spots, because once you understand how these layers fit together, you're no longer operating purely on assumption. You're making decisions with visibility. And that alone changes how you interact with your money in a meaningful way. And once you start examining the system through that lens, where structure matters just as much as headlines, you begin to notice something else. Banking isn't the only area where quiet changes are occurring beneath the surface. It's just one piece of a much larger puzzle, because the same kind of pressure we've been discussing, tightening conditions, shifting rules, increasing dependence on confidence, is showing up in other parts of the economy too. Credit markets, real estate, sovereign debt, even how liquidity moves globally. They're all connected. And when those connections start to strain at the same time, the effects don't stay contained in one place. That doesn't mean everything breaks. It means the system adapts. It restructures, sometimes gradually, sometimes all at once. And the people who navigate those periods best aren't the ones reacting to headlines after the fact. They're the ones who understand the underlying mechanics early enough to adjust before it becomes obvious. That's really what this comes down to. Not predicting a collapse, not assuming the worst, but recognizing that the foundation isn't static. It evolves. And right now, it's shifting in ways that most people haven't been shown clearly, because consider how this entire situation unfolded. A vote occurred, rules were adjusted, a 90-day window opened. And unless you went searching for it, unless you read through regulatory filings or followed specific channels, you probably never noticed it. No major coverage, no widespread explanation, no moment where someone broke it down in plain terms for everyday people whose lives are directly connected to it. And that gap, that space between what's occurring and what's widely understood, is where the biggest disconnect usually lives. So the real takeaway here isn't just about banks, it's about awareness. It's about understanding that the systems you rely on don't announce every meaningful change in a way that's easy to see. Sometimes the most important shifts are the quiet ones, the ones that don't interrupt your day, don't trigger an alert, don't force your attention, but still reshape the environment you're operating in. And right now, you're in one of those moments, a narrow window, where something significant has changed, where there's still time to understand it, still time to examine your own position, still time to decide how you want to respond before it simply becomes the new baseline that everyone adjusts to after the fact. You don't need to overreact. You don't need to assume the worst. But ignoring it entirely, that's the one option that leaves you completely exposed to whatever direction things move next. So take a closer look, run the numbers, understand where you stand. Because in a system built on confidence, the people who ask better questions tend to make better decisions, and right now, there's one question that matters more than anything else. Are you operating on what you assume is true or on what actually is? I'm Milena, and this is Golden Desk.